Are you wholesaling real estate under your own name? I'm going to show you a better way to structure your wholesaling business to avoid negative tax implications and protect your assets in case a deal goes south. If you want to learn more about how to properly structure all of your real estate investments and protect your assets, you can register for our tax and asset protection live event at the link below. Now, right now, I'm going to show you how to set up your wholesaling business so you can protect yourself and have more control over your deals. So let's address this up front. There are two problems with wholesaling properties in your own name. One of them is going to be tax and the other one's going to be liability. So what does that mean? Well, from the liability side, it's pretty straightforward. If you were to go out there and I'm going to find a property, so here I am as a wholesaler, and I'm going to get this property tied up under contract with this seller over here, and I'm going to enter into a contract with that seller to buy this property. And then I'm going to go out here and I'm going to try to find an investor that I can flip that contract to. Now, most people think that when you're buying real estate, that is when you enter into this agreement here, the most you stand to lose is your earnest money. So for example, if I had to put down $1,000 on this deal and I don't close, or this investor over here that I sold my agreement to fails to close, the most you're out is $1,000. Well, as a wholesaler, what you need to appreciate is that these are contracts you're signing here. And when you enter into agreement to buy a piece of property, yes, it has earnest money that goes down, but that is not the only remedy that is available to the seller if you fail to close. And what can happen in certain wholesale deals is that you flip this deal to an investor. Let's say I bought your deal from you. I look at the property and then I run into financing issues that I don't have the money to close, so I just walk away from the deal. Yeah, I lost some money that I paid you and I didn't close on this property. Well, that seller, because the seller tied up their property, let's say it's for 30 days, maybe you got an extension on it, so it's 60 or 90 days. The value of the property has gone down. That seller can turn around and sue. And they're not going to sue the person that you flipped the deal to. They're going to sue you because they had your name on the agreement with them. You're the one that entered into that agreement. So you have liability. So that's a problem that you need to work around. You don't want to wholesale in your own name because you have personal liability there. Trust me, I've seen it happen before. I've had people send me letters from the law firms threatening to sue them because they did not close on a property that they were trying to wholesale. Now that's the liability side. The tax side, well, that's a whole completely different animal that we need to be concerned about, because when you're wholesaling with real estate in your own name, you're going to be treated as a sole proprietor. All of the income you generate from your deals, this is going to be what we call active income to you. So that means you're going to file a Schedule C on your 1040, which means it's going to be subject to 15.4% employment taxes on every dollar you earn, up to about $120,000. So as a wholesaler, I don't want to be stuck in this situation where I'm having to pay too much in tax on my deals. I want to find a solution that allow me to cut my taxes, especially my employment taxes. This is what we're looking to minimize. So if you're going out there to wholesale real estate, you got two problems right off the bat. You're going to pay way too much in tax if you're doing your own name, and you're going to get hit with liability should a deal not come through. Now, the next issue that comes up a lot of times with people who are going to wholesale properties, they want to know, Clint, should I use a limited liability company or should I use a corporation for my wholesaling business? Well, that's really going to depend on a multitude of different factors when we're trying to figure out which entity we're going to use. Now, for instance, a limited liability company right here. The unique thing about an LLC is that you can choose how you want to treat it for federal tax purposes. That is, you can treat it as a C Corp, which means it's going to file taxes in its own tax rate, which is currently 21%. You can choose to have it created as an S corporation, which is a flow-through. Now, you would never choose to treat this entity as a disregarded entity or a partnership for federal tax purposes, because that puts you back into the initial problem I stated with tax planning, that if you do it as a sole proprietor, you'll be treated as a sole proprietor with those two elections. So we're going to stick with a C or an S. That's how a lot of people will set up their LLC. Or you could set up an Inc., a traditional corporation. And with that, you have the election. You can go C or S status for your traditional corp. So the question really becomes, which of these two structures should you use if you're going to be wholesaling? Now, a lot of people, they just go for the LLC because so many practitioners out there will tell you, set up a limited liability company, everybody does it. And there are some benefits to setting up a limited liability company for your wholesaling business. The chief two benefits that I can think of that come to mind is that with a limited liability company, you have protection not only from what happens on the inside. So for example, if my LLC entered into an agreement to buy this piece of property and my investor didn't close, the creditor or the seller would only sue the LLC and not me personally. So that's a benefit. The other benefit you have with the limited liability company is that here you are down here as the member of your LLC. If someone sued you personally, depending on where you set up that LLC, well, they wouldn't be able to take your limited liability company from you because hopefully the LLC you're creating has what we call charging order protection. So your business offers you protection from what happens on the inside and from what happens on the outside. So this makes it a very popular form from an asset protection standpoint to use for wholesalers. The other benefit of using the LLC is that it's much easier to run. You don't have to have annual meetings and things like that when you're running a limited liability company, which you do if you set up the traditional corporation. So the traditional corporation, the problem that many people have with using a traditional corporation to run a wholesaling business is that it's a lot of crap you got to work through, right? Each and every year you got to have a director's meeting, you have to have a shareholders meeting, you got to remember to do this, because if you don't do this, then it gives someone that sues your company ability to what we call pierce the veil of that business entity and go after you and sue you individually. So that's a drawback. Now, what's a positive of using a traditional corp, an Inc. versus a limited liability company? Well, here's the benefit of using an Inc. Let's say that you're going to go out there and you're going to spend, I don't know, make an investment of $15,000, $20,000 to learn how to get started in wholesaling. A lot of people do that. They'll invest in education. Now, the benefit of having a traditional Inc. is that if you make that type of investment, if you're getting trained by someone, if you're going to hire a coach to walk you through your business, I would encourage you to look at a traditional Inc. because if that business doesn't work out for whatever reason, let's say you run it for a year and you just can't get any deals under contract and you just can't flip them to an investor, and you've invested into getting this business started $18,000, right, in education and coaching expenses. Well, if you started with a traditional Inc., then we could close that business down and you could pick this $18,000 up as a tax deduction on your 1040. You can write it off. That deduction I just shared with you is only available to a traditional Inc. The LLC, you can't do that. You can take a portion of it, $3,000 a year, but it's going to take you 6 years to write it off. Whereas if you're done with a traditional corp, you could write it off in year one. So that is a positive. And so if I'm looking at someone and they're saying, Clint, do I set an LLC up for my wholesaling business or do I set up a corporation? My first question is going to be, how much are you investing in yourself to get started in this business? If it's not very much, go with the LLC. If it's a lot, I would go with the traditional Inc. Now, once you've got that nailed, then you have to determine how am I going to treat it for tax planning purposes. Now, when it comes to running a wholesale business, I wouldn't necessarily set up or make an S election to treat it as an S corporation for my wholesaling business. Why don't I want to make an S election for my wholesaling business? Because when you make an S election, what it means, it's a flow through. So if I had an LLC set up here, treated as an S corporation, and my business brings in this year $100,000. Now that $100,000 is going to flow down and be taxable to me individually at my tax bracket. Let's say my wife's out here working and she's making $200K. I bring in $100K. Now our income is $300,000. So it's going to push us up into a higher tax bracket. With an S corporation, you don't have any control over your income. Everything flows down to you and you pay taxes on all of your earnings. If you want to have control over your income that you're generating from your wholesaling business, then I would strongly suggest that you should look at setting up a C corporation. The thing about a C corporation is twofold. So when you set up a business, say we'll just go traditional Inc. right now, and I choose the C corporation tax status. Here's the first benefit. If I make $100,000, it's going to be taxed at 21%. So on my $100,000, in this example, I'll have $79,000 left over after taxes. Now I'd be wondering, well, Clint, if I want to take it out, am I going to have to pay taxes again? Yes, you will if you pull the money out. But if you're going to leave the money in the business, because let's say you want to start getting started in flipping real estate, because wholesaling tends to be one of those activities that people start with and then they branch into into flipping. I mean, that's the way I got started. Went from flipping and then I went into acquiring residential real estate. So if you want to have more capital left over to invest in flipping real estate, the C corporation is going to be your better bet than an S corp, because the S corp is going to push it down to you and possibly tax at a higher rate. Now, the other benefit, how does a corporation impact your ability to borrow money? Because when you transition out of wholesaling and you start buying property, of course, you're going to start working with lenders and using other people's money. The thing about using the corporation, a C corporation that is, rather than an S corp or a flow-through entity, is that that income doesn't hit your tax return if you don't want it to. The other aspect about it is that when you're using say an S corp or a flow-through, those things kick off what is called a K1. And so this K1 is attached to your 1040. So when you go in to borrow money from a bank and the underwriter is looking at your 1040, what they're going to see is that you have this K1 from an LLC that you set up as an S corp. The next thing you're going to know is, hey, tell us all about your S corp. What does it do? How much income is it generating for you? So when you're using a C corporation, it's not a flow through, so you do not have K1s with C corporations. The underwriter that's looking at your 1040 would not even know that you have a business on the side that you're running. All they're going to see is the income that you report on your taxes. So if I had a C corporation here that I was running for my wholesaling, what I would do is set myself up as an employee, pay myself a W-2, which lenders really love, W-2 wage earners, pay myself a W-2 and then have that W-2 show up on my 1040 and make there'll be nothing on my return that shows I have my own business over here on the side. So from that standpoint, I think that the C Corp has other benefits as well that you couldn't get if you were to set up an S corporation because of that flow through treatment. Now, the other thing to consider when you're entering into a wholesale agreement is whether or not your purchase and sale agreement with the seller permits assignability. Now, what does that mean? It means that you can assign that agreement to a third party. So if I have my corporation here set up and I enter into an agreement with this seller to buy this piece of property, and I have this investor over here that I want to kick the deal to put them in connection with that seller, that purchase and sale agreement has to be assignable. Now, in certain states like Texas, for instance, all contracts are assignable. But in other states, the seller may have a purchase and sale agreement that does not permit assignability because they don't want you taking that deal and kicking it to someone else, because then what they did is they left too much meat on the bone and they're thinking, hey, you're going to profit from my property. I think not. So if you're working with a seller that does not allow for assignability, then what you should look at doing when you're marketing your wholesale deals is choose a different entity. What I like to do is I'll possibly set up a land trust or maybe even a limited liability company that's owned by my corporation. And now when I enter into these deals, rather than have my corporation enter into the purchase and sale agreement, I'll have my land trust, or what I like to use is called a wholesale trust here at Anderson. We created a very specific wholesale trust agreement to do these deals. It's similar to a land trust, and the reason I use land trust is most people are familiar with that tool, but really it's a wholesale trust. And then what happens with this is that when you find this individual over here, the investor, you'll kick them the trust and they'll step in to the trust. And now it doesn't matter if there's a prohibition on assignability in your purchase and sale agreement, because you're moving the trust to the investor. So whoever owns that trust can then close on that property. And that's one way you get around those situations. Wherever the contract prohibits assignment of the agreement, fine. I'm using a wholesale trust in my deal. The reason why I created the wholesale trust for Anderson is because we were running into issues with our clients that had that concern. They said, the seller won't allow assignability, even though I tried to get it worked in there, or the seller wouldn't allow a novation clause. Okay, great. Use the wholesale trust. Now, there's some great ways here in which to set up a wholesale business. If you want to learn more, I want to invite you to our tax and asset protection event. Listen, if you're a real estate investor and you're considering getting started in real estate investing, or you've been investing for a while and you want to learn more about LLCs and land trusts and wholesale trusts and corporations and how they can be implemented from a liability and business planning standpoint. You're going to learn that at our tax and asset protection workshop. If you want to learn more about taxation, how you can use real estate to greatly reduce your taxes, you're going to learn that about that as well. But more importantly, we're going to show you how to build a business around your real estate investing. And what's so unique about this workshop, which brings people to it, we typically have 1,000 to 2,000 people on our workshops when we host them, is that when you come there, you're going to be able to get your specific questions answered. That is, we have a team of professionals, attorneys and tax professionals that'll be on this event with me while I'm speaking, answering your individualized questions. So if you're wondering about real estate and asset protection, you want to learn more, listen, click on the link, get to this event, and that's where you're going to get your questions answered.